Right, so we'll get started. So welcome everybody again. Today we have Xiumin Martin from WashU who's going to take us through a paper. So before we get started, I'll just again thank you all for participating and coming along. We do have, again, we're filling out the schedule. So here's a list of upcoming speakers. You know, please keep checking the website. We'll sort of send out reminders every now and then as well. So just to remind everybody as well, so the rules of engagement, although I'm sure a lot of you will repeat participants. Xiumin will present for about 25 minutes or so. And then when she's done, we'll sort of open it up to the Q&A. So during that time, if you want to write in your questions into the chat or write something in the chat so we know you have a question, then we'll call on you in the Q&A part. So with that, Xiumin, feel free to share your screen. Should kick this off. Let me stop share. Then you should be able to take over.
Let's see. Okay. Does it work?
Yep.
Okay. Well, thank you so much for University of Miami, and thank you for inviting me, giving me the opportunities to present my work. This is really exciting. You know, when we are stuck at home, we can still present our work. Thank you. So this is my paper. We just finished a revision. So this is definitely the best time to present the work and to collect the feedback. Therefore, you know, whatever your suggestions and comments that you have, please do share with me, either sending your comments to me after the workshop, or sent to my co-authors. I truly appreciate this opportunity. Now I'm going to start this presentation. So the title of this paper is Accounting Information Quality Priced in Managerial Labor Market? And this paper is co-authored with Xinhua Gao from Washington State University. I think he's Xinhua already dialed in. And Yunhong Jia from Iowa State University. They both dialed in. And they're going to jot down the comments for me. So if you have any comments, please send to them. What motivates us to study this topic? I think, you know, before I start the motivation, I want to clarify what do we mean by accounting information quality, just because, you know, we have a different versions, different understanding what accounting information quality really means. So by accounting information quality, we follow Francis et al. 2004's definition. That is the degree of uncertainty or imprecision of financial information in predicting the future cash flows of a company. And the higher the uncertainty or imprecision, the lower the accounting information quality. Prior research has argued and provided some evidence that poor accounting information quality affects the quality of decisions made by various market participants. For example, in merger acquisitions context that Marquardt and Zerr 2014 management science paper shows that, you know, when targets have a low accounting information quality, then that imposes higher uncertainty on the acquirers. Therefore, it takes a longer time for a merger acquisition deal to go through, and exposed it affects the deal's completion. And then in other contexts, in the equity market context, that prior papers published in the accounting review shows that when firms' accounting quality is low, then there's higher dispersion in analyst forecasts. That again indicates that poor accounting information quality increases the uncertainty. So as a result of high uncertainty, attributed to the poor accounting quality, then various papers has demonstrated that market participants price in this uncertainty. For example, Francis et al., that 2004 paper shows that poor accounting quality is positively associated with cost of equity. Then in the debt market, Baraz et al. 2008, the accounting review paper shows that poor accounting quality is priced in the debt in terms of bank debt or bonds. Then in our paper, we want to see how this uncertainty or some other elements induced by this poor accounting quality is priced in the labor market. Well, we know there is a heterogeneity in terms of the labor markets, and Brandon et al.'s paper focuses on the rank and file labor markets, and we focus on the managerial labor markets. And there's different elements of differences between the two segments of labor markets, and I think these two papers taken together can shed some light on this issue. So to be clear, the research questions we want to investigate is poor accounting quality associated with CEOs' compensation? And we're going to explore various mechanisms why there will be association and going through what mechanisms. We understand from our research question and our empirical analysis, we are not able to use any sophisticated identification strategies to make sure that identification can allow us to draw this clear causal evidence, but we try to do our best to control for various elements that affect the compensation, try to give some kind of push on this causal inference. In particular, I want to indicate that we focus on the new CEO, external CEO hires, just because a big concern related with the identification is the endogeneity, right? The reverse causality issues. So by using the external hires, hopefully they will have no influence in the past accounting quality of the firm they're going to join in. Hopefully we can kind of alleviate this reverse causality concerns. And obviously we also are going to address other correlated omitted variable issues. Prior research on executive compensations shows that in a competitive labor market, executives price in any risk in their compensation. For example, Peter and Wagner 2014, that JF paper shows that CEO demand high pay premium for the high job security risk that induced by stock return volatility. And then subsequent paper, the contemporary paper by Chimera et al. 2013 shows that CEO's compensation also reflects the financial risk, the capital structure induced the financial risk or bankruptcy risk. And Cutter et al. 2019 accounting review paper shows that executives, because of uncertainty about their matching quality with the firm, so new executives also price in that uncertainty about the matching quality. So our paper is going to build up this stream of prior literature. Prior literature also shows that accounting information quality can affect the private benefits extraction. So in the managerial research that Jing and Meyer 2006 shows that managers, in the opaque firms, they're able to extract the private benefits. And subsequent paper, Hunting et al. 2009, that GFE paper just explicitly tested that conjecture. And they demonstrated that poor accounting information quality is related with the subsequent stock crashes, right? Because that allows managers to kind of hide the information, hide the private benefits they extracted. Therefore, that usually the information comes out in a chunk because of this hiding of the information. So our prediction is also going to be built on this private benefits aspect, how the accounting information allow managers to extract the private benefits, and then how that's going to affect the pricing in accounting information quality. So to summarize, the accounting information quality is going to affect the compensation, managerial compensation through the risk channel, as just now argued. And the risk specifically we're going to talk about is the job security risk, as well as the accounting misreporting risk. So this channel, accounting information quality, is associated with accounting misreporting risk, is kind of pretty straightforward. That has been demonstrated in the prior literature. So I'm going to discuss this channel, accounting information quality and job security risk, in detail just in a second. And we are also going to consider how the accounting information quality affects the private benefits, that aspect, and see how this private benefits extraction is going to affect the relation between accounting information quality and the compensation. Presumably, it's easy to or it's intuitive to see that, when managers can't extract the private benefits, they may not price in the accounting information quality as much as in these situations. That's kind of our intuition. Well, by the way, because I just now mentioned that we just finished this revision and we're waiting for collecting the feedback on how to improve our identification, etc. So if you have any thought on that dimension, I really will appreciate. All right, so to summarize, accounting, to go into details why accounting information quality is going to affect job security risk, we're thinking about at least these three non-mutually exclusive channels. So first, accounting information quality could affect the ability for managers to tell a firm whether it's a lemon firm versus a peach firm. This is a classic lemon car markets, and then uncertainty induced by this poor accounting quality probably limits managers' ability to tell the firm's type. Therefore, they price in that. This is pretty kind of easy. And then accounting information quality could also affect the matching quality assessment ex ante, right? So Cutter et al. Shows uncertainty about the matching quality induces manager to price that risk in, and we argue that accounting information quality could affect the assessment of the matching quality. And then the third channel is the accounting information quality could also affect the effectiveness of managers to implement their strategies, right? So any new managers, when they come into the firm, they have their own carried strategy packet, and when ex ante, the accounting information quality is low, that probably affect their assessment, whether they can implement their strategies effectively or not. And accordingly, that's going to affect their job security risk. Therefore, they're going to price that in. So by no means that these three are mutually exclusive. We try to argue that these probably represent some channels that why managers will price in the accounting information quality. How I'm doing in terms of the time, 15 minutes. So I have 10 to 15 minutes.
That's great.
Good. So now I'm going to go to the specifics about the empirical side. So we measure the accounting quality using two measures. One is the Xiumin 2002's paper. And then we want to highlight here is that to make sure that AIQ is ordered in terms of higher AIQ indicates higher accounting quality, we just put a negative sign on this accruals measure. Using an alternative measure developed by Kastari et al., performance matched accrual measures, our results all go through. So I'm not going to show any result concerning this alternative measure, but I just want to let you know they're all robust. All right, now I'm going to the sample. Our sample starts from 1994 up to 2018. And we, as I mentioned, we focus on externally hired CEOs. It's easy to say, but it's a kind of a non-trivial work to identify which CEOs are external hires, which are internal hires. So we went through extraneous labor work to identify these external hires to improve the precision of the sample. So in the end, we have 940 externally hired CEOs. And this is a distribution by industry of CEOs pay distribution and the accounting information quality based on the DD measures, the Xiumin measures. So this distribution shows that, as indicated in this highlighted blue row, you can see that the firms for telephone and television transmission industries, that their accounting information quality is low relative to other industries on average. And their CEOs are paid more in this industry. In contrast, manufacturing industries and firms in wholesale retail and their accounting information quality are relatively higher, and their CEOs are paid relatively lower. So by no means this is a causal evidence, right? I just want to demonstrate the pattern, kind of consistent with our argument. And this graph depicts that also well. So as indicated, this gray bar shows the CEO total compensations, and the orange lines show the distribution of accounting information quality across various industries. And you can see that this bar, telephone and television transmission industries, they have a higher CEO pays and they have a lower accounting quality. So this is again to confirm that table. Our empirical identification, there's no identification, I have to say that we just ran regressions trying to address the correlated omitted variable issues and other endogeneity issues. So we regress this is a pretty standard specification. We regress the natural log of CEO pay on the AIQ measures, and then on various firm level or contract level or industry level and firm level controls. That's kind of, we try to do our best. Then this is a summary statistic. Given the time concern, I'm not going to talk about them in details, but on average, CEOs are total pay is about $3.8 million, and the median is much lower, so $2.1 million. And the AIQ measure, accounting information quality measure, is kind of distributed in this way. Now I want to show the main results. So table 3 shows that our measure accounting information quality is negatively associated with the CEO pay. And the economic effect is also pretty significant. So one standard deviation increase in the AIQ measures is associated with a reduction of compensation by about 7%. So this is a pretty significant, because you think about standard deviation of return is used to capture firms' risk, and this variable economic magnitude is about the same as our AIQ measures. So one standard deviation increase in the volatility of stock returns is associated with 7% increase in compensation. And now I want to just elaborate a little bit on what kind of controls we throw in to deal with this potentially correlated omitted variables. So the first column, we tried, the first 3 columns we try to address is to throw in contract level measures, CEO compensation contract level measures. So column 1 controls for the presence of severance pay. Second column control for pay mix, equity versus cash. And column 3 try to control the delta and vega effects. So after these staggered introduction of these controls, our results are pretty robust. And then the column 4, we try to control for the governance variables, because you could argue that a firm's accounting quality and the compensation both are related with the firm's governance structures. So we try to control for board size, outside the proportion of outside boards, whether boards are busy or not. After introducing these corporate governance controls, again, our results actually get even stronger. And column 5 try to control for reasons for the CEO turnover, right? Why prior CEOs they left the firm, and then that induced the new CEO to come in. So we try to control for forced CEO turnovers, and whether the new CEO comes, or whether the turnovers is accompanied by CFO turnovers, and also we control for the prior CEOs who left the firm, their pay. So all these are kind of are trying to address these correlated variables, and our results are robust. And at the next level, we control for the CEO characteristics. You could argue that the new CEO characteristics could be correlated omitted variables. And we try to control their education. We also control, even more interesting, we try to control for their prior compensation in other firms, in their predecessor firms, and our results, again, is robust to that. So again, in terms of the time concerns, I'm going to move on to the next issues. We try to explore the channels why CEOs will price in this accounting information quality. What is in our mind, as argued before, is job security concerns. So we look at, subsequent, following the CEO, joining the firm, how many CEOs experience the turnover. So we look at, starting from year T, they join the firm, and follow them through. So you can see here the percentage of CEOs experiencing turnover is much higher in the earlier years than later years, right? After year 3, that's going to, the turnover rate is reduced. So this tells us, for one, that CEOs experienced a significant amount of uncertainty in the early years. And then we break down into 2 baskets, high accounting quality versus a low accounting quality firms. We show low accounting quality firms have a much higher CEO turnovers. And then in our regression analysis, we use proportional hazard model to estimate this duration analysis. We show that low accounting information quality is associated with a higher occurrence of subsequent turnover. And now I want to move on to the misreporting risk. Do we show that misreporting is higher for firms that have a low accounting quality? And indeed, this is the case, that low accounting quality firms have much higher misreporting risk. You know, the misreporting here, we say we identify those accounting restatements that with the misreporting period that occurred before the new CEO joined the firm, but these cases were revealed after the CEO joined the firm. So those, in these instances, these occurrence of these misreporting has nothing to do with the CEO, right? But these CEO bear the cost, either through the job security risk or through the reputation damage. Now I want to elaborate a little bit about the private benefits channel. As just now I argued that when firms have the opportunity for the CEOs to extract the private benefits, then low accounting quality probably allow them to extract the private benefits more than the high accounting quality firms. This is because low accounting quality will shield the external monitors like the shareholders to monitor the firm, whereas high information quality firms allow the external monitors to monitor the CEOs. Therefore, in these cases, our negative relation between AIQ and the compensation might be muted. So this is indeed we show in this result in table 7. So when firms have the boards that tend to monitor the managers, they demonstrate stronger negative relation. In other words, in these cases with strong corporate governance, that CEO tend to price in the AIQ, whereas in those poorly governed firms, CEOs tend not to price in this. All right, the last table will demonstrate cross-sectional differences in terms of the pricing of AIQ in their compensation. We show that CEOs that are young or CEOs in the firms that adopted in the state of inevitable disclosure doctrine, we show that the results are stronger. So the argument is that young CEOs, they care about their job security more, and the cost induced by turnover risk is higher. The same with adoption of inevitable disclosure doctrine. So for firms located in those states that adopted this, their outside job opportunities are low, so managers tend to price in this in a full term. All right, so I just want to use 1 minute to talk about our contribution. We think studying this topic is interesting and important because we demonstrate whether the labor markets and particularly in the managerial labor markets, price in this accounting information induced risk. And we view our paper complement Brandon's paper in terms of how this risk is priced in the labor markets. We also think this paper is interesting to identify the mechanism why the managers will price in the accounting quality. And last but not the least, it extended the labor economics in terms of identifying what risk is priced in the labor pricing. Thank you so much. I look forward to the comments.
All right, thank you, Xiumin. So we'll get started with the questions. So Sundaresh, do you want to kick it off?
Okay, I'm just wondering about how this actually works. You got these statistical associations and the cross-sectional tests and everything else, but I'm looking at it from the point of view of a prospective CEO, right? I'm looking at this company, how am I judging what their accounting information quality is? Was there an event before that kind of triggered this whole thing? For example, did the company have a restatement, so I'm doubting what the quality is? Or is it just a gut feeling? I just go in there and basically like, this doesn't look all that good, right? And, so it just seems to me that, if you are hired from a competitor, maybe the CEO knows something about this firm, but if you come from outside the industry or something, I have no idea what this is, right? And they're not running Dichow models to find out, how good the AIQ is for a particular company. So, from a realistic standpoint, how do I go about judging what the AIQ of a prospective, employer is?
Excellent question, Sandrash. I think I thought about this a lot. The way I go about this this issue is that, to be realistic, CEO may not run the Dichow model, even if they know, right? But I think just like you said, they have some gut feeling, right? They want to, before they join the firm, even at the stage of searching for, whether this firm is the one that I want to join with, I want to marry with for my next 5 or 6 years, I need to analyze the firm, right? Whether it match with my style and all the elements I just now talk about to evaluate the effectiveness of their strategy to be implemented. And they look at the past financial statements if that's an important source. I think it's probably fair to say they do look at the financial statements, right? To analyze the firms and to see, this is a good firm or bad firm, match with my style. All these will be reflected in their assessment of the risk. And given that accounting information quality will be reflected in the financial statements as attributes, and they may not consciously think about the Dichow model's indication, but they have a sense, this firm probably looking at their financial statements, can I kind of assess their future performance well or precisely or not?
Yeah, I think it'll help your case if you're going to make that point that, you look at CEOs that move from competitive firms versus CEOs that come from outside. That to me is a little more credible story. Or look at past history of the firm. Did they have any, press-worthy kind of problems with their accounting, right? I mean, something, because, otherwise, if you're just a random regular firm, it's very hard for, a CEO, I would think, to judge what this thing is. Thank you.
Thank you, Sandrash. I will think about it, and and hopefully we can address that at the conceptual level.
Christina?
Yes, hello. Thank you, Xiumin, for your presentation. So my question is about, you talk a lot about CEOs and how all this is from CEO perspective. And my question is about the firms. So what do you know about accounting information quality of firms where CEOs used to work? Okay, so maybe CEO is joining this current company which has bad accounting, bad everything, right? but he or she is coming from a firm where he or she did a great job. So is this important to consider in your setting, in your study, to make the story more complete?
So Kanya, can you please, I don't think I.
So you identify your outsider CEOs, right? And they worked for some other companies, if I understand correctly. So my question is, what do we know about accounting information quality of their past employers?
Oh, in their prior employers, I see.
Because it's a matching, right? So you talk about that they will get higher pay because they will sense higher risk at this current company.
Sure.
But what if they are just better CEOs and accounting information quality of the previous employers were higher and now they are hired to fix this company or something?
Right. Yeah, definitely. This is something that we have thought. So just now I mentioned probably just very briefly that we try to control for their prior employers' compensation for this new CEO. So just now you said, the CEO is somehow they're of higher quality and they're able to deal with this, opaque information scenarios, so they're paid higher. That's, their quality constitutes a correlated variable. So we control for their past compensation from their prior employers. Hopefully, I think to some extent that addresses this kind of a endogenous matching. But point well taken, and we're going to think about more carefully. Thank you.
All right, Sanders, did you want to ask another question?
Yeah, with the, your choice of external CEOs, you kind of ignore, people promoted from within, right? You don't have the internal guys because, you're worried about reverse causality and so on. But it almost seems like that's an interesting control group, right? These are the guys who cannot be fooled by low AIQ. So why not use them to see, there could be other reasons why I pay the internal guy less than the external guy, right? But it just seems to me that throwing away that part of the sample, you could actually use it as, the AIQ is not going to fool them about how good the company is, right? So they have
Absolutely, Sandra. Actually, so to get to this point, we did look at the internal hires. We also look at those CEO, the externally hired CEOs who serve on the board for the firm in the past, right? And along the line of your argument that these instances represent lower uncertainty. So do we see a less pricing sensitivity? Indeed, we saw. So I think this is, I agree with you, this probably is going to help to address this, to see in what situations that this uncertainty is more pronounced, less pronounced, help to build up the credence of the results. Absolutely. Thank you.
If you already did that, it seems like, you should be including that in the paper because that'll settle my first point, which is, actually it won't settle that, but at least you'll be able to show that your story that I don't know about your company, flies a little better if you contrast that with somebody who knows about the company and is not fooled by the accounting.
Yeah, definitely. I think the reason, point well taken. The reason we didn't included in the current draft is still on your point. The reverse causality is an issue there for the internal hires. Yeah.
I don't get the reverse causality point, but thank you.
You're welcome. The reverse causality point is that, if
No, I understand the reverse causality. I'm just saying I don't see how it applies to the new internal CEO, but that's okay. All right, I'll let other people ask questions. Thanks.
Thank you.
Miguel?
Hi, Xiumin. Thanks for coming to our webinar series. I will also, as we've been doing since last week, I'll send you the comments and suggestions from our PhD reading group.
Thank you.
Yeah, we usually try to put together 5-7 suggestions, questions, or main issues that the PhD students have. Sort of one thing that kept coming up is whether is truly accounting quality versus all of the other things that we all know that these residual measures capture, right? Unfortunately, without other measures of financial reporting quality, we all know that accruals are really mainly capturing losses, impairments, bad business models, volatility of revenue, and all of that. So it's not really that CEOs are aware of quality, they're just aware that this is a bad firm. It's not a bad story, but it's a very different story. I don't know what you think about that.
Yeah. These are the issues that we're struggling with, and they're very, very challenging. As we admitted at the first level or at the minimum level, we have to acknowledge, right? These are correlated or mediated factors that may drive the results. So we have to be very humble at this level. And second, we try to do whatever we can, and this workshop is excellent to get us, into those challenges and how to address these challenges. So all the suggestions we welcome. So what we have done, as I mentioned briefly in the presentation, is that we control various aspects: the firm level, state level, contract level, and CEO level.
But unfortunately, we also know that all of those controls affect the accrual calculation non-linearly. So it's going to be very difficult. I think it's typical practice, at least in all of the earnings quality, audit quality, financial reporting quality papers, at least use one measure that is not accrual based. That is the common practice now, right? And I think that has come up as, unfortunately, once you intersect CEO dismissals with things like restatements, you're going to end up having a very small sample. But that's what you sort of expect to see, right? There is a CEO that is going to take a firm that has had a restatement or has material weakness in internal controls, and then this CEO will be paid to either take risk or fix these issues, right? That's also another aspect that the paper doesn't address. Is this just a risk-taking premium, or is pay to actually fix these issues, right? Which should also come up in a different test. For example, whether weights of the compensation contract are put on accounting measures versus non-accounting measures, right? If accounting is so bad, I don't want any of my contract being tied to accounting measures. Or maybe I do if I want to cheat. I really don't know.
Good aspect. So for the restatements, so on the one hand, restatements that occur, it's not occurred, that is revealed before the new CEO joining the firm. We have thought about those situations. Indeed, the signal, the revelation of the restatements is a signal for outsiders to kind of think about the firm's accounting issues, right? But on the other hand, we could also, prior research like Shiva's paper shows that firms might just, mitigate this restatements or fraud-induced restatements, right? They fix it up in the next year or 2 years, and then end up like these firms may have a better accounting quality. So because of these complications.
Sorry, but the vast majority of the literature and the vast majority of market observers will see the revelation of a restatement as a high-risk event. I mean, if this is not a restatement that happened 6 years ago, right? If the restatement was just revealed the year before I joined and the prior CFO or CEO was fired because of the restatement, it seems pretty obvious. Now, the problem is, as I acknowledge that, this is a very rare event, right? So, but there are other things, material control weaknesses or changes in the CFO's office. And by the way, I think this paper, all the story, everything applies perhaps much better to CFO compensation than to CEO compensation.
Well, so point well taken. So this part, we also have thought a lot about this. In terms of the job security risk, mentioned before, at least, three non-mutually exclusive factors or channels could induce the higher turnover risk of the CEOs. Those dimensions may apply to CFO, may not. I think the pure direct impact on the information risk on restatements, that will apply to CFOs. So that's kind of why we think we would like to look at CEOs. But your point is well taken. CFOs may also subject to similar economic forces.
Sure, thanks.
Thank you.
All right, Yini, did you have a question?
Yes. Hi, Xiumin. Thanks a lot for your presentation. So my question is, do you consider to decompose the total compensation and see which specific component is driving the risk premiums? Because if the additional compensation is to reward the new CEOs for their willingness to take on extra reputational risks, then we would probably expect to see the cash components be driving the result.
Good point. Thank you. Again, we also thought about that too. So we did decompose the CEO compensation into cash versus equity components, right? And then we saw the stronger effect takes place in the equity part. So for one, we think, yeah, maybe just like you said, maybe the cash compensation, cash compensation compared to equity component, they are less risk, right? If you want to price in this risk as a substitution, you want to use a cash component. But on the other hand, we also know equity compensation, particularly for the new CEOs who has no ownership, almost zero ownership of the firm stock before they join the firm, that usually firm give more equity component. So this is a fact. So in that sense, and we think probably it's not surprising we find the stronger results in the equity component. And as a side, the Mary Ellen Carter et al.'s that accounting review paper also find that their matching quality uncertainty induced by the matching quality assessment is also priced in mainly in the equity component. So our results is kind of consistent with theirs.
Okay.
Do you have any thoughts on that?
So then, do you think the firms expect an improvement on the accounting information quality over the new CEO's tenure?
That might be, yeah. We did explore. You look at on a time series fashion to see how the firm's accounting quality measured by our empirical measure, how that changes. And surprisingly, we didn't see much variation there. So our understanding is that, as I argued before, that accounting quality can be affected by, innate factors, business cycles, and etc. Also can be affected by the manager's own discretions, right? So our evidence seemed to show that probably the innate factors is dominating in our setting.
Okay. Thank you very much.
Thank you.
Chibe, if you had a question. Sorry if I pronounced that incorrectly.
No problem. Even for Dutch people, it's extremely hard to to pronounce. Yeah, thank you so much for the presentation and this great initiative to keep research going. Also for me from Europe to participate. Yeah, I wrote a couple of comments in the chat. I think that the most important one is also the one discussed relating to CEO pay. And so we know that this equity part in CEO pay is the most important part and really drives a lot of their pay. But from the like GAAP or accounting side, we know that the share price of the company really goes into that accounting. And I saw that you controlled for kind of the mix between cash pay and equity pay. But is there also some way that you can control for the relative share price, right? Because if the share price goes up, then also the amount that they account for in the 10K for the CEO pay also normally goes up a little bit depending on how they settle the share options. But I would guess a pretty strong relation there if you put it into a regression. I'm not sure what's your view on that.
Yeah, thank you. I'm guessing that the time, not sure in Europe, which part of Europe, probably is pretty late.
Netherlands, yeah, it's almost 7 o'clock in the evening, but it's fine. It's still light, so and I'm happy to join. It's pretty cool start of the weekend. Yeah.
Excellent. So thanks for your comment. And we control for the compensation contract level characteristics. For example, the Vega, capture the risk, right? You could argue that the compensation is related with the Vega, and you think about delta, Vega, all these parameters constitute an overall package that affect the total compensation, also affect the firm characteristic as measured by the accounting information quality. So that's kind of what is in our mind. So we control for delta and Vega. Delta capture, pay for performance sensitivity, and Vega capture the risk. Is that something that in your mind is the share price effect?
I'm not too familiar with those variables and that literature, but I mean, as long as some relative share performance goes in there, I think that's really important. So I'm really somebody who's coming from practice and now trying to do a PhD. So I'm way more into it from a practical side, right? From okay, well, what's the journal entry? And we just know from okay, with equity settled stock options, that if the share price goes up of a company, that just the amount that accounting wise we book really increases for that year. And there are some really small sensitivities to it, and accounting can be really complex with those contracts. But generally, the share price is a very important element in it.
Okay. So I think in your question there are at least two elements on that. As a new CEO, when I come in, how my contract is parameterized, right? And how my exposure to firms' stock price changes. And I would say that part is captured by their Vega, the parameter of Vega. And the second component, how much is a firm's or these managers' compensation, particularly the equity component, is associated with the accounting, right? So the second part of your question is that, quite a bit, I studied the annual incentive plan. Annual incentive plan a lot of times is based on accounting measures, for example, ROE, ROA, etc. And these are has a significant equity settlement, right? If your performance, you meet this certain accounting target, then how much equity you're going to get. So I would say that equity component actually is associated with the accounting performance to some extent. Yeah.
Okay, thank you very much.
Thank you.
Dan, do you have a question?
Oh, yes. First, thank you for the presentation.
Thank you, Dan.
Okay, I was curious that if there's an alternative story that there's a scapegoat possibility for the new CEO. So when I read this paper, I was thinking if the incumbent CEO knows the financial reporting quality is very poor, the CEO might just choose to retire and let the next guy to deal with it. So from the perspective of the board try to bring a CEO that is highly paid. So they overpay the CEO to take the bad firm due to the information asymmetry. So that also consistent with the story with GE. So the incumbent CEO are retire and leave all the risks to the next CEO.
Right, and these kind of information, hopefully these uncertainty, we call it, broadly speaking, we categorize the situation as a high uncertainty situation from the new coming CEO perspective, right? They come into this firm with a lot of issues, and how they from their perspective, how they're going to think about their compensation, right? How they're going to think about, you know, how much risk I'm willing to assume, how I'm going to price those risks.
So the
I think go ahead. Yeah.
Sorry. So the scapegoat possibility is also taken into consideration by the new CEO.
Yes. So from, I think just now you talk about mainly from the board or the compensation committee point of view, but from the new CEO point of view, I'm paid high, right? I'm paid with high compensation, but also I bear high risk. If you will, those risks are associated or caused partially by accounting information quality, then our story will go through.
I see. Thank you.
You're welcome.
Chi Chen?
Hi, Xiumin. Thank you
Hi,
for your presentation. Hi, thank you for your presentation. I think this is probably consistent with your argument, but except for the supply side, which you mentioned about career concern risk, like the private benefits extraction, do the result also indicate that those firms are actually actively tend to attract someone with better the managerial capability to deal with those bad operational performance, and therefore offer the higher pay contract? I think this is probably consistent with your argument, right?
Okay, so thank you. So first of all, I think in your mind, you know, there's something in our mind about the private benefits, but I think in your mind, you're thinking about firms are poorly governed that allow CEOs to extract the private benefits. That might be some in their consideration. They want to hire high quality CEOs so to deal with these situations. Is that right?
Yes.
Okay, yeah, so it is consistent with our story, but more than that, in our empirical analysis, we do control for corporate governance. We're saying that holding the corporate governance constant, right? And then to see accounting information quality variation, how that affects the pricing. But yeah, it's possible. It's possible if corporate governance is associated with the accounting information quality demonstrated by prior research, right?
Thank you. That makes sense. Thank you.
Thank you.
Thanks. We had Shane, but I think he's jumped on another call, so the comments there. But we can share all these questions in the chat with you, Xiumin, too. In the interest of time and to hear from someone new, we'll go to Emma. Wayne?
Oh, hi. I'm a PhD student from University of Toronto. I think you already addressed part of my question. I was just curious about this time variation of AIO. You mentioned that in your empirical test, you find after arrival of new CEOs, AIO doesn't change over time. So it seems to me that it's more consistent with the business story, the risk story, instead of AIO. Like, why do they hire high quality CEOs? And I assume at least a portion of the firms that have new CEOs was with the purpose of improving their AIO quality. So if this low AIO situation is not desirable for CEOs, why don't we see a change?
Absolutely. Thank you so much, Emma. I think that this is something that I have not thought about it. And it's entirely possible. So, so both are probably happening. It just on average, we don't see significant change in the accounting information quality. This is an average evidence. However, in the cross-section, maybe some firms try to hire the high quality CEO, whatever the CEO with certain properties to fix the accounting problems. It might be true. So in the cross section, I would say that maybe it's interesting to look at in those cases how this accounting quality evolves and then how they initially price this. Yeah, thank you.
Thank you so much.
All right, we probably have time for maybe one more question, Chiba, if you wanted to. I think you're still muted.
Yeah.
You're going to want to unmute.
Ah, sorry.
Yeah.
No, I think we pretty much covered it also with the other people who asked questions. I really enjoyed it. It was my first session just to sit in, but cool. Thanks for the great organization.
Thank you. Probably Emmanuel will welcome you to come back.
Of course. All right. Well, in the interest of time, we don't want to hold anyone up. Thanks again for joining. The video of this will be made available online. Hope to see you all next week. I think we have Sugata. And yeah, it's been great. Xiumin, thank you so much.
Thank you so much, Emmanuel. And also thanks for everyone to dial in. And hopefully, if you have any residual questions, please send it to me or my co-authors. Thank you.
Cheers. Bye.